Good morning. This is Barry Knapp with Ironsides Macroeconomics. It's 7 a.m. Mountain Time, Monday morning, September 2nd. Our note this week was titled Discounting the Detox. And that was the theme that ran through the note. The idea was the equity market has looked through the detox from our addiction to government spending, hopefully transitioning to a pickup in private sector capital investment as we end the year and move into 2026. But the detox obviously runs deeper than that. Tariffs have played a role, as has the slowdown in immigration. And that was evidenced in last week's revision to the second quarter GDP number that shows just how much consumption has slowed and how much government spending has federal government spending in particular has reversed. If we just go back through the last four quarters, and the fourth quarter of last year, third quarter of last year, government spending increased at an 8.9% annualized rate going into the election, continued at a robust 4% rate in the fourth quarter. In the first quarter of this year, it contracted by 3.7%, and in the second quarter, contracted by an even greater 4.7%. So all that's taken its toll on consumer spending and services spending in particular. This is not just all about tariffs. The impact of these policies has slowed services consumption. There's been some recovery in capital investment in certain categories, but structures investment, research and development investment remain weak, and that's on the come. And we discussed that a little bit later in the note within the context of the regional Fed manufacturing and services surveys, the last of which were released last week. Now, the stock market has been pretty rational with respect to all this in the sense that the consumer-facing sectors, staples in particular, but also consumer discretionary, have underperformed fairly significantly the investment beneficiaries, industrials, tech, communication services, materials, and even energy's done a little bit better as of late. The yield curve has steepened. Some have talked about this within the context of Fed independence. That's not what we see. It's being driven by real rates, and it's being driven by a rally in the belly of the curve, twos, fives. And this is about the Fed needing to start cutting rates. The Fed is obviously well behind the curve, not obvious to everyone, but obvious to us. And we do think that we're getting set up for a Fed rate cut. Now, we're going to put out a payroll preview note for our full paid subscribers, probably why you should consider becoming one tomorrow after the JOLTS report is released. The one indicator we got last week was the Conference Board labor differential. Recall that survey's been around since 1967, has a very strong historic relationship with the U3 unemployment rate, and it suggests that the U3 unemployment rate is something really above 4.5%, not the 4.25% that we got last month from the July report. We think that data was distorted by the way the BLS accounted for immigration. They didn't have a pickup in immigration in 22 or 23 when the border was wide open. Suddenly they found 2.9 million extra workers last year. That's distorted that data. So we do expect a fairly weak report this month. We then went on to discuss inflation. That's one of the pushbacks we get about our view that the Fed should be cutting, and looked at how the personal consumption expenditure deflator was not below 2% in the 90s, was not below 2% through most of the 2000s. The only period it was in the 2010s, and that was primarily attributable to an exogenous force, which is China's massive excess global capacity that caused goods prices to be very weak. The domestically determined services and housing numbers were above that. Furthermore, if you removed housing from inflation over the last 2 years, inflation's been below the Fed's target for 2 years, actually. So that's, for us, not a reason that the Fed should not be cutting rates. Now, when we look through all those various regional Fed surveys, we can see the impact of tariffs on weak capital spending plans and orders stabilizing, but still fairly weak in the manufacturing sector, whereas there is some indication in the services sector that Capex plans are improving since the passage of the reconciliation bill known as One Big Beautiful Bill Act. We then finished our note up with some thoughts on the IEPA decision. This is one of those things, if you've been a full subscriber, we first started writing about this in April and expected that it would be declared unlawful. We think that the Supreme Court will likely uphold that, though in a little bit more limited way. And no, they won't be returning, the government won't be returning tariff revenues. And then we had some thoughts on the tech sector and a very interesting report that came out of MIT that indicated some 95% of the companies investing in Gen AI right now are seeing zero return on their investment. So we think this is a powerful technology, but we also think we're going to go through waves where there's gut checks on just whether the investment has gone too far. So Barry Knapp from Ironsides. Have a good week, everyone. Again, please consider becoming a paid subscriber. If you need a trial for a month or so, let us know. We're more than happy to do that. Have a good week, everyone. Thank you.